Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're gonna talk about 4 areas that real estate can help you build wealth over time, especially generation over generation. Stay tuned, there's gonna be a bonus at the end of the video with my thoughts as always. And very quickly, I just wanted to finally announce that Whiteboard Finance University is live. We essentially have our 4 pillars of wealth building. We have money management, how to increase your income, stocks, and real estate. It's been a long time in the making. You can check it out down in the description below. But let's get into the video. Thanks. Okay, so the first way that real estate helps you build generational wealth or gets you rich over time is through appreciation. So this is pretty easy to understand. People can understand the concept of appreciation, but I'll show you why it matters, especially when it comes to commercial real estate. So real estate has typically gone up in value over time. So for this entire video, I'm going to use multifamily as an example. So these are just apartments. Anything that's 5 units or greater is considered multifamily or considered commercial real estate. So there's 2 ways that appreciation can happen. This is by simple supply and demand. Say you're in a great location with limited supply and high demand, obviously the price for that property is gonna go up over time. But the more common way that real estate investors make their money is through forcing the appreciation, and this is by increasing the NOI. So if you don't know what NOI is, this is just a fancy term for EBITDA. So if you don't know what EBITDA is, this stands for net operating income. EBITDA is earnings before interest, taxes, depreciation, and amortization. This is basically a snapshot in time, measuring the income producing ability for the property before financing or taxes. So this doesn't take into account taxes and then also loans. And I'll show you a quick example right now. Okay, so here's a quick example of NOI and forcing the appreciation, so stick with me here. So on this left side, we have income. On the right side, we have operating expenses. So let's say our rental income is $10,000 for the year. And I'm just for the sake of small numbers and being able to fit this on the whiteboard, I'm using smaller numbers. So if you're looking at bigger properties, these numbers, I would add a few zeros, but just for the sake of this example, follow me here. So parking, let's say it's $2,500 a year. You're charging people to park there. And let's say your laundry is $500 a year. This brings our total revenue right here to $13,000 for the year. And if we have management fees, let's say those are $500. We have property taxes, which are $3,000. We have maintenance and repairs on the building, $1,500. And then we have property insurance, which is $750. So the total operating expenses ends up being $5,750. So all you have to do to figure out your NOI is to take these 2 numbers. You take your total revenue, $13,000, minus your total operating expenses. This gets you an NOI of $7,250. Now, if you wanted to figure out what the value of this property is based on the cap rate, so cap rate, to confuse things even further, is basically the type of return that the investor is looking to get from the property. In really good markets, cap rates are compressed. You're only gonna get 3, 4, 5% on certain properties. And worse neighborhoods, worse properties, worse geographies, cap rates are gonna be a little bit higher. For this example, I'm gonna use a cap rate of 7%. So I would take this 7,250, divide it by 0.07, 7%, which gives you a value for this property of $103,571, okay? Now, if we wanna force the appreciation of this property, let's just say we bump up rent. Let's say we increase it to $12,000 and we increase parking to $3,500, right? We make some improvements in the property, we make the units a little bit nicer, squeeze out more rent, improve the parking lot, charge a little bit more for parking or offer covered parking, for example. You just added $3,000 of NOI to the bottom line. So in this case, our total revenue is going to be $16,000. If our operating expenses stay the same to $5,750, our new NOI is going to be $10,250 divided by 0.07. Now this gets us a value of $146,428. So compare 146,428 to 103,571 for the same exact property. We didn't change the location of the property, we didn't change anything about it except for maybe improving the interior and some exterior components, and we basically raised the value of the property by almost 40%. So that's how you force appreciation. That's the first way you can get rich in real estate. Okay, the second way that real estate builds wealth over time is by nuking your tax bill. This is through depreciation. That's why I put a slash through tax right there. So depreciation is defined as a reduction in value caused by wear and tear, deterioration, or decrease in price of the property. And this is basically a tax write-off for that year. So for property owners and investors, depreciation allows a tax write-off for the current tax payment year. Generally, multifamily, the example that we're using in the last slide, was 27 and a half years. If you're looking at pretty much any other commercial real estate type, you're looking at 39 years. That means how much you can depreciate it over. However, with cost segregation and bonus depreciation, investors can actually take their deductions over a much compressed time period. So like 5 years, 7 years, 15 years, for example, which will greatly reduce their taxes and increase their cash flow. So our monthly guest expert inside of Whiteboard Finance University is actually the car wash guy. If you guys don't know him on Twitter, it sounds like a funny name, but this is basically someone who's gonna be teaching our students how to nuke their tax bill through cost segregation and bonus depreciation. So if you haven't signed up for Whiteboard Finance University, do that now in the link below. He's gonna be an incredible guest. So let's go through an actual example here. So let's say we have a $1 million building, right? We're depreciating this, let's say it's multifamily, so we're depreciating it over 27 and a half years. So as an investor, you'd basically be able, at the tax rate of 3.636, you'd basically be able to write off $36,000, let's just call it $300 per year over 27 and a half years. But what if we actually compress this through a cost segregation study? Now, if this depreciation was taken over a 7-year period, the investor would be able to take $142,000 loss for that year. That's an annual depreciation deduction. So this is why in my videos with Roman, if you remember all my house flipping videos showing you how to flip houses, he doesn't pay an enormous tax bill through all his flip gains because all of his rentals offset his flipping business profits, right? So the next two are gonna be super juicy. That's why I saved number 3 and 4 for the end. But before we get into that, check out a word from today's sponsor, Policy Genius. If you have a family, you know how much your loved ones depend on you. In a worst case scenario, you wouldn't want them to worry about money. A good life insurance plan can give you peace of mind that if something happens to you, your family will have a safety net to cover mortgage payments, college costs, or other expenses so they can get back on their feet and focus what's on most important. Life insurance through your workplace may not be enough protection for your family's needs, and it won't follow you if you leave your job. Let me tell you from personal experience, it is super satisfying to check life insurance off your to-do list, just like my wife and I were able to do with Policy Genius. Policy Genius knows how valuable your time is. That's why their technology makes it easy to compare life insurance quotes from America's top insurers in just a few clicks to find your lowest price. With Policy Genius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options offer same-day approval and avoid unnecessary medical exams. Their licensed, award-winning agents can help you find the best fit for your needs. They work for you, not the insurance companies. That means they don't have an incentive to recommend one insurer over another, so you can trust their guidance. Policy Genius is for parents, caregivers, and anyone else who has people who depend on them. They simplify the process of getting life insurance so you can protect the people you love. No wonder they have thousands of 5-star reviews on Google and Trustpilot. Your loved ones deserve a financial safety net. You deserve a smarter way to find and buy it. Head to policygenius.com/whiteboardfinance or click the link in the description to get your free life insurance quotes and see how much you can save. Number 3 is cash flow. This is obviously what people think of when they think of real estate investing in general. This is obviously money that is generated by the property minus the money that it takes to maintain and uphold that property. This is your cash flow, your CF. So this can obviously be positive or negative, and this is important because, or it's so powerful because cash flow dictates the NOI, AKA forcing appreciation. So we talked about the net operating income in the first slide. Your cash flow is basically going to be your biggest component of dictating whether this property is cash flow positive or cash flow negative. So if you're cash flow positive, your building is producing an income stream and is able to service the debt, AKA pay off your mortgage for you. So not only is basically the property, commercial at least, valued on what its NOI is and divided by the cap rate at the time, you're also servicing debt, which I kind of gave you a sneak peek of what number 4 is gonna be, which is leverage. So some commercial real estate investors simply choose to cash out refi, which allows them to borrow against the property. So that's why NOI and cash flow is important, because obviously you can take out a certain percentage of whatever the value of the property is. So, and you can do this tax-free. So if you haven't checked out my video on buy, borrow, die, to learn more about this, check it out. I'll probably leave it up here or in the description somewhere or at the end of the video. So what I'm trying to say is with NOI, say we divide this by a certain cap rate, right? Remember we did this in the first slide? That gives you the value of the building. You then say, hey, Mr. Loan Officer, my building is worth $1 million because of my NOI divided by my cap rate. How much money can I cash out refi on this? And that's typically up to a certain loan to value, right? Loan to value of the building, let's say it's worth $1 million. Let's say your loan to value is 80%. This family can now pull out $800,000 tax-free in a cash out refi, slap on some new debt on it, and they get this 800 grand tax-free. And that's when they buy their second house in Florida. Okay, makes sense? Okay, number 4 in the final piece of wealth building in real estate is leverage. Ah, yes, OPM, other people's money. This could be your friend, your family, the bank, a syndication. There's a million ways that you're able to acquire and control a piece of property using other people's money and without the full asking price, without coming up with the full price of the property. So leverage is simply controlling 100% for 20%. Well, that's just a very simplified bullet point. You're basically using other people's money, controlling a piece of property for a fraction of what it's worth. So when you go to buy a house, do you buy a house for its full asking price, or are you putting 5% down, 10% down, 20% down, and the bank is financing the rest through a mortgage? Okay, so this is as simple as buying a $100,000 property with $20,000 of your own money out of pocket and having the bank pay the other $80,000 in the form of a mortgage. So when used properly, leverage can skyrocket your returns and is always usually the better way to build wealth than using straight cash, right? So you have a levered method, which is just the tool in your toolbox. It's a double-edged sword. It can hurt you, it can help you. Or you can go the Dave Ramsey route, which is paying 100% cash for a property. So let's take a look at what cash on cash is. I've talked about this a couple times in my channel, but cash on cash returns are simply pre-tax cash flow, what the property throws off before taxes, and also, this is a very simplified version of cash on cash return, right? So just think of pre-tax cash flow divided by the money you have invested into the deal. So that your total dollar outlay, AKA your equity invested. So let's take a look at the same property, right? The same $100,000 property that I just mentioned. Let's say its cash flow is $12,000. You paid 100% cash for this property. So you have 100 grand plus some fees. We'll just keep it 100 grand. This is simple math. This is 12% cash on cash return. So the property throws off, let's say $1,000 a month, $12,000 a year divided by the full purchase price or equity outlay. This gives you 12%, right? Now let's take a look at the savvy real estate investor who has the same property. He only put 20% down, AKA 20 grand out of pocket. Guess what his cash on cash return is gonna be? It's going to be 60%, okay? It's 5 times more powerful than the person who paid cash. You see that difference right there? So this is leverage in a nutshell. This is a very simplified version of leverage, but I just want you to kind of get the picture in this slide. Okay, so to conclude the video with my thoughts, which I always give at the end of my videos, real estate has been a great historic inflation hedge. So real estate is typically kept up with inflation and is a great inflation hedge, especially a couple years ago. So the reason I have percent greater than percent is because of this. So imagine locking in a 30-year fixed rate mortgage at 2.5% a couple years ago, while now being able to earn 5+% in a risk-free guaranteed rate of return of like a T-bill or a high yield savings account, right? So this debt is not only being eaten by inflation, especially if your wages are inflating with inflation and your dollars are inflating, you're now making a positive return by locking in your rate at 2.5, for example, while you can earn 5+ now in a high yield savings account, which is what I'm earning. And then finally, Whiteboard Finance University, just since you watched this video, Real Estate 20, you get 20% off for the lifetime of your membership. Basically, in a very small nutshell, we have 4 pillars and 4 learning paths. We have how to increase your income, how to manage your money, how to invest in stocks, how to invest in real estate. These are all taught by professionals. These are experts. The one guy writes for Forbes. The other guy owns 500 units on the East Coast. He has a $40 million real estate portfolio. And the other professor is a CFA, Chartered Financial Analyst. This is not a $5 a month Discord, okay? This is not a $5 a month Patreon. This is a serious way to learn financial independence, direct access to me every week on a live stream, and also 3 other professors. It is no joke. It is my goal to make this the best finance education platform in the world without charging too much and making it available to everybody. So if you got value out of this video, check out Whiteboard Finance University. Check out the 20% off with REI20. Thank you so much and have a prosperous day.